I may only be young, but I still manage to trade profitably. And in this video, I will show you the step-by-step strategy and mindset that I use to trade profitably. Here is a funding screenshot if you don't believe me. And also, if you still don't believe me, we will just go over to my Discord server. I have been trading and posting my live trades for years and years and years. So you go back over this and you'll see years and years of trading. This hopefully gathers myself a bit of credibility that I know what I'm doing. And if you want to check the Discord server out for yourself, the link is in the description. I post my live trades every day as they happen. Now we've established that I know what I'm talking about, I will then get into the chart and we can discuss exactly how I make my money. This is the S&P 500 futures, and we'll just ignore the chart for a second and let's go into the theory behind my strategy. So this will be a quick rundown of the rules I use. If you need or you don't know any of the concepts that I use, I have made videos on them and I will make videos on them going into them in depth and my own perspective into them. And I won't go into detail too much about what stuff like liquidity is or something now. That'll be for a later video. So we are on our chart and I will tell you exactly step by step my strategy. So the number one thing I do, the first thing I do when I get on the chart is I mark out key levels, okay? Now, what are key levels? Key levels are going to be previous day high/lows, market high or lows, and hourly high lows. So this will be on the 1 hour chart or the 4 hour chart, okay? Now, why do I use these key levels? Well, these key levels help me identify places where liquidity is resting, as my strategy revolves all around liquidity. So once I've marked out the key levels, we can then identify where in the market the liquidity is resting, so we know if the market ever gets to one of these points, we are going to be up for a trade. Now, let's say we're the market, just for example, we're on the 4 hour chart and it looks something a bit like this, where it does something like that, okay? So this is our chart on the 4 hour. You can use something called the horizontal ray, which is really useful in my opinion. And what we could do is we can mark out areas of all the highs and lows and the key levels. So on the chart, if price was here at this moment, where would the key levels be? Well, obviously they'd be at this point down there, this point here, and this point up here, because they're previous areas where prices bounce, previous lows and previous highs. Now, I don't want to go into too much detail. This is quite simple. If you don't get this, I've made previous videos and I will make other videos on stuff going into depth. But these is what key levels look like. So now we've marked out key levels. The next thing I look for is I wait for price to sweep one of these levels. Now, what it means for price to sweep one of these levels is purely for price to go up and break one of these levels like so. Go up, push past the level, and that is very simply what a sweep is. So price could just go straight up here, it could bounce and then come up to this level, or price could bounce down and sweep below these levels. All of these is what I mean by waiting for price to sweep one of these levels. The next thing I do is I wait for a change in market flow. Change in market flow or direction if you want to make it sound easier. So change in market flow is very simply a change of character, okay? It's what I think some people will call it a change of character. Now, what this means is, let's say price is moving in an uptrend, higher highs, higher lows, pretty simple stuff. If price would all of a sudden break this trend and then come below a previous low, you would say that the market structure has shifted or the market flow has changed direction. And this indicates that price is maybe going to be starting a new downtrend in this example, and price is no longer going to be following in the same direction as before. So in this example we have here, let's say price bounced up above this level and we had an uptrend, higher highs, higher lows. We swept this key level up here and then we retraced and we broke this previous low. We have had a change of character and we've changed market direction. And then next, we'd wait for a retest or an entry. So a retest, which we'd use as our entry. Now, what is a retest, or what would we use as a retest? Well, we use stuff like maybe an order block or a fair value gap or an inverse fair value gap and stuff like this, which would give us confluence to enter. So let's say in this example, in our pullback, price created a fair value gap in this zone during the rundown. So it swept, came back down to change character, and in this sweep back down to change character, it created an imbalance or a fair value gap. Like here, we had an FVG. What I'd do to wait for my entry is I'd wait for price to come back into the fair value gap, and that is the next confluence. I wait for price to get into the fair value gap. Once we have a retest entry into a fair value gap / order block, I need to then wait for a rejection / confluence candle. Pretty much just a candle formation or something that shows me that price is going to want to bounce off of this area. So once I've seen maybe a candle closes like this, okay, off the area, or maybe we see a hammer candle like this off the area, both these things show that price is respecting this fair value gap and it's bouncing off of this area. This shows that price is most likely going to reverse trend, and this is where we want to get into our trade. So what I'd do is I'd wait for this bounce off. I'd go for, in this example, a short position at this area. Our stop loss would be above the next swing high, and our take profit would be at the next area of liquidity. So in this example, you'd have some areas of low level liquidity, low resistance liquidity, and these are previous lows that aren't that significant but do hold some liquidity. So areas like this and this, and I choose where I want to put my take profit, because obviously we have another area of liquidity down here at this major swing point, maybe on the 4-hour chart or the 5-hour chart. Obviously, this strategy works on any time frame. So if you want to be a swing trader, you can do it on a higher time frame, or if you're like me, I prefer doing this on the 5-minute time frame or the 1-minute time frame. But it really doesn't matter what time frame you use, as long as you're marking out these key swing levels here and here on a higher time frame, because they hold less weight on a lower time frame. So we've established that you have these areas like so of liquidity which you can target. I would target the next major point, but I'd also have some take profit levels in with some of these other levels here. So I'd have a take profit 1 in an area of low level liquidity, but I'd have my major take profit down here at a higher level. So here, depending on what the trade looks like, but maybe I'd take 30% profits and then let the rest run into the actual take profit. But it all depends on the market. No market is going to look the same and no chart is going to look the same. So you have to kind of have a bit of thinking about it, of what you're going to put it. So very simply, this is what my strategy is. It's these 5 rules you want to wait for, and quite simple, just same strategy, same process over and over again. So I will show you an example of where this happened on a chart in real life. And this is an example that happened recently of the trade that I actually took. So if we go to the S&P, which is what I've been looking at, we're going down to a lower time frame. If I can find the trade, here it is, this trade here. So this was the 7th of July, just 2 days ago, at around US Open. You see it's 1:30 here. I'm in the UK, so the US markets opens at 1:30. But this is the area I'm working with. I'm going to draw a box around it so I can find it on the higher time frame. So we do our first rule, and that's mark out previous swing highs or lows. So if we're working around this blue box here, where would our previous swing points be? Well, you'd have a swing point up here, swing point down here. You'd also have a swing point on the top of this 4-hour candle here. And if you can't see by my face count, there's the toolbar I'm using. And anything else, yeah, that would be the 4-hour swing points. We move down to the 1-hour chart. Could we find any more swing points? Well, we'd have a swing point down here at this wick, and I think that's all. So the 15-minute chart, we're just kind of seeing market structure, what's going on, any more swing points we've missed. Well, we'd have a swing point down here on this wick and a swing point down here on this wick. So this is what our chart looks like with all the swing points laid out. Just some black lines moving across is pretty much all you need for the higher time frames. So now I'd move down to the 5-minute chart, and I'd go back to this area, and I'd look at when market would open is when I start trading properly. So let's mark out with a vertical ray of where 130 is. So 130 is there. So we'll change that to red to make it a bit clear. So after this red line is when I start trading. So let's start looking for entries. Well, we see this black line is a swing point. Number 2 in our strategy was swing point, sweeps. Where did liquidity get swept? Well, if you see here, this high got swept at this point here because it broke above that line and retested and rejected off. So our second confluence, if I can find it up here. So here are our rules. We've marked out the previous highs and lows, the key levels, and we've waited for price to sweep one of these levels. And we can clearly see that price has swept this level up here. So now we need to wait for a change in market flow or direction, or a change of character, as you can see. And after price has swept it here, if we're looking on that side of the chart, did price do it? Well, price changed market flow, if I get rid of this red line, here, because you had at this point there, at this point here, because price broke below this level and changed market structure. Because before, you were creating an uptrend structure. We had a low, a high, a higher low, a higher high, a higher low, and a higher high. We were clearly in an uptrend. But all of a sudden, price broke this low here and changed market direction, which is our third confluence here. So after we see this, we need to wait for a retest into a fair value gap or an order block. So if we zoomed in and pretended like this was real life, I spotted when I took this trade a fair value gap here and a fair value gap here, and we had an order block up here. So we had an order block and 2 fair value gaps. Now the important thing about fair value gaps is if you have a fair value gap below and above, you always disrespect the one that's in the bottom and you take the one that's in the top if you're in shorts. If you're in longs, it's the other way around. But if you have fair value gaps in a row, you always take the one closest to the swing point. So I then waited for a retest or an entry into a fair value gap order block. So we had price change market direction, retrace back up into a fair value gap, and we saw a rejection off of it. The rejection is clearly this wick here. This wick was once a full candle like so into this area. But the sellers drove this candle down into looking like so. Well, because it shows, this clearly shows that the sellers sold in this area here, in this fair value gap. So this to me shows a rejection. So I got into my short position at the bottom or the close of this candle after this candle closed with the wick. Where would our stop loss be? Above this high up there. And if we zoomed out, where would we target on this trade? Well, we target these previous swing lows. So you could target this as your take profit 1, this low down here, and then you could target these 3 areas. Now I'd probably be safe and target probably the middle one, just in case the bottom one wouldn't get hit. But any of these levels can do, and you can have all of these or treat all of these as different take profit areas. But I chose this third one in the actual trade I did, and as you can see, it played out 1 to 3.4 risk to reward ratio. And this is a very clear example of a trade following this strategy. So just to recap, we marked out our previous day highs and low using these black bars here, 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 and here. We then waited for price to sweep one of these levels, going down into a lower time frame, which we saw here. We then waited for a change in market flow or direction, which we saw at this change of character there. We then waited for a retest or an entry into a fair value gap, which we saw here. And then we waited for a rejection, which was this wick. And with all of these confluences together, I knew I had a good trade, and the rest is history. So I hope you guys have learned a lot from this video. This is a strategy I've developed myself and I think has been working really well for me. If you want to see my live trading and all the trades I post so you can learn more, you can head over to my Discord section. We have a community here. I have affiliate links to prop firms, but also I have my live trading here. And our trading goes back years and years and years and years, which you can see for yourself. And that is linked in the top of the description. But other than that, thank you very much for watching my video, and I'll see you guys next time. Peace.